and I'm doing $10 an hour work. And I got the phone jammed to my ear. I'm like, I got pizza boxes. I'm doing all this shit. And I got the phone to my ear and I'm talking to Jake. And we're negotiating an $11 million deal. All seller finance, 80% bank, 20% seller. This is the deal of a lifetime for me. It's $11 million. We walked away from closing with $110,000. The title company's like, I've never seen this before. I'm like, you may never see it again. We still own that deal. We refied it twice. Deal's probably got to be worth, no joke, it's 300 unit deal. It's probably got to be worth $30 million right now. We just kept refining it. It's in a great.
Welcome to the Real Estate Reserve Podcast. I'm Jason Balin from Hard Money Bankers. This is Ian Horowitz from Equity Warehouses. If this is your first time tuning in, welcome. We certainly appreciate it. We promise we're all going to have a ton of fun. If you are a return viewer, follower, listener, watcher, thanks again. We truly appreciate all your support. As always, we always like to have a lot of fun with this show, and we also like to bring on great guests. And I know that this guest that we're going to bring on here in a second that Ian's going to introduce, you guys are going to love. So we're going to have a lot of fun here today.
Yeah, no, I'm excited. We're leading up. I don't know when this show is going to come out, just after the new year or just before the new year. You know, now's the time to get in, do real estate, go out there. If you've ever wanted to do it, either from an operator standpoint, or you wanted to be a passive investor, or you just want to have real estate in your portfolio, now more than ever. There's a lot of stuff. We're going to do a prediction show here shortly, talk about what we see in 2024. So I hope a lot of it comes true. Guys, if you get any value out of this, please like, share, subscribe. We only bring in people who are actually doing deals. We don't like to bring in gurus. We bring in people who are actually doing deals and providing their experience that they have inside of real estate. So with that being said, I want to bring in Gino from Jake and Gino. We're going to have him here on the show. We're going to talk about how to grow and scale a multifamily portfolio. Gino, what's up, brother?
Ian, I'm doing good. Jason, thanks for having me on. And there's two things I got to say real quick. Number one, I want to be the guru. I'm the guru who's doing it, right? Because that's what you want to do. These guys out there teaching it, you got to get dirty. And it's a great business. And the second thing to your prediction, I predict that anybody listening to this 5 years from now are going to say, I wish I got into multifamily 5 years ago. That's the reality. It's never the right time to get in unless you're ready. It's always the right time to buy real estate. It's not always the right time to sell it, but it's always the right time to start buying real estate, guys. Thanks for having me on today.
Yeah. All right, that's it. That's the show. We don't need anything else.
I'm just getting started, my friends.
Hey, man, we're already having fun. We're already getting value. We're freaking good to go, man. Freaking cut it off. So Gino, how you got to tell us, how did you get started with real estate? What year was it? What was your background before that? How did this kind of whole Jake and Gino thing start out?
I wish I had gotten into real estate earlier on in my career. I got into the restaurant business because of my father. I was an 8-year-old little kid going to work with my dad. He had his restaurant, and I fell in love with the restaurant business. I fell in love with how hard my dad worked, how committed he was, how he never complained, how he was always working and providing for the family. And I fell in love with that vision. And when I got out of college, I wanted to work in corporate for a year. I mean, have you ever worked in a cubicle? That sucks. Let me tell you, that's like watching paint dry. And I said, I can't deal with this anymore. I mean, like when you're used to going to work, working 12-hour days and, making people happy, I was doing the opposite in corporate. So I went and opened the restaurant with my dad, my mom, and my brother. And we had the restaurant for about 15 years. And then my dad in 2007 passed away. And I know now that I started hating being there, and I didn't know why at the time, but he was with me for the 37 years of my life every day. I could always count on him. I think I liked the restaurant because I was with him. And then when he passed away, the Great Recession comes. All of a sudden, you got Grubhub. You got people wanting Panera. They're getting Domino's Pizza. It sucks. The business, I'm not making any money. I'm working harder. How many of you out there feel like that? I'm on a hamster wheel. And I'm like, I got to do something else. I know this real estate thing is good. My mom owns the building. I've been paying her rent for the last 20 years. She's got 3 apartments upstairs. Well, how do I get into this real estate thing? I had made a couple of huge mistakes. And then in that 2008, I read that book from by T. Harv Eker called The Secrets of the Millionaire Mind. And that book just changed everything for me. All of a sudden, I was complaining like a little bitch. Everything was none of it was my fault. And when, T. Harv Eker's words really spoke to me and said, your fruits are in your roots, and everything you've done up until this point is all on you, and it's all your responsibility. It just, a switch went off in me. I don't know, midlife crisis, wanting something different. I jumped into, this whole multifamily thing. I got mentorship. I started investing in mentors. I met Jake in 2011. Jake moved down to Knoxville, Tennessee. He was a pharmaceutical rep at my restaurant, and he wanted the same thing. He hated New York. He hated the taxes, the weather. He hated the W-2 job, and he wanted to do something entrepreneurial. So let's get together. Let's do this real estate thing. And, after 18 months being down there, we bought our first deal, and I guess the rest is history. But it really was from a desire of just wanting to get out of the W-2. And for anybody listening to this that doesn't think that real estate's risky, I just challenge you. I think everything's risky. Go work for a boss. Go work for a W-2. If I was still in New York right now, post-COVID, I wouldn't have a restaurant. They would have shut my ass down. I would have lost 25 years of my life because of something that I had no control over. So is there risk in that? There's risk in everything, people.
Yeah. I'll never forget, like, a few years after we started our business, my business partner, Chris's mom, approached both of us and said, hey, isn't starting that business kind of risky? We're like, what do you mean? She's like, well, it's risky. You're starting your own business. And we're like, you have a W-2 job, you have a boss who you don't like, and you have one income stream. Like, let's define what's risky in this situation. Yep. And I mean, when I think you present it that way or the right way to somebody, they understand, right? You could lose your job. You could be a great employee. You can still lose your job, downsize, whatever the case is. So I think real estate investing, entrepreneurship, owning assets in general is as far from risky as it can take if you do it responsibly, obviously.
Jason, I had a very similar situation to you. In 2006, I met a guy. I call him Maserati Mike, and he pulls into my restaurant, and I partner up with this guy. And, I say to myself, I have $172,000 in the bank. I'll never forget that number because 18 months later, it was gone. and I always want to blame Maserati Mike. But it was really ultimately what T. Harv said. I did no due diligence. I should have never gone into business with this person. There were no values alignment. There was nothing. But my mom was always in my background saying, that's risky. That's risky. So I never even told her that I was partnering with Jake until I had 200 units. And at the 200 unit mark, I sat her outside of the restaurant one day in a park on the bench. And I said, Mom, I'm about to leave the restaurant about another 6 months. She was flabbergasted. So this is a woman that I would be with every single day. And I had to hide it from her because I knew she was trying to protect me. I knew that story would always come up. It's too risky. You've got to stay small. We're not entrepreneurs out there. As the economy's contracting, you got to. And I'm thinking that's like some of the worst advice that I could get, but all she was trying to do is to protect me. That's all she knew. That was from her paradigm. Okay. And I knew that it wasn't Maserati Mike's fault. It was my fault. And how am I going to get better? So for those of you out there that are struggling, just find a group like a Jake and Gino or like another community that really can support you and that's trying to achieve what you're trying to achieve, because it's really hard out there to find people where you can level up to. So for those of you out there, 200 units, didn't say anything to my mom. Then when I told her, it was like I had betrayed her. Like, how'd you do that? Well, that's a story for another day, Mom.
Why didn't you tell me?
Yes.
My son's growing up, finally. I really wanted to say. So talk about that first deal that you were hiding from your mom. Talk about, 200 units. It sounds like you tried doing real estate before. Obviously, your mom's laughing all the way to the bank. You're paying her every month. So you kind of knew that making passive income is the right thing to do. What did that first successful deal look like with Jake that you guys bought in Knoxville, Tennessee? And I think to be clear, you're still living in New York. You're still living in New York at that time. You got boots on the ground with Jake. What's that deal look like?
Ian, that's a great question. And for me, I always like to break my life up now. In the last year or so, I've been breaking it up life before Jake and life after Jake. That's the reality. Because life before Jake, my first deal was a triplex. And it was beginner's luck. It was great. I owned that deal for 20 years. I just sold it back in 2020, 21. I sold it. But the second deal was like that mobile home park, which was terrible. Then you think I'd learn. 3 months later, I had bought a strip center up in New York. Crappy deal. Owned that for 10 years. I always tell people no deal is better than a bad deal. And that was the epitome of that. If I had not done that deal, I may not be here right now, but that deal really sucked the total life out of me. And then when I met Jake, to me, everything changed. And, we talked about it in our book, we wrote Wheelbarrow Profits. We found the map, we found the process, and we call it the buy right, manage right, and finance right process, where we're using a framework. And when you hone in on something and you're doing it, and every deal is very similar. For us, we were buying from mom and pops. That was a mom and pop owner. We had our buy right criteria. We understood the financing. We get into this the show, but I didn't have a process before Jake. I was all over the place. I had a shiny object syndrome. I'm going mobile home parks, strip centers, duplexes. Then when I realized, let me just focus on one asset class. Let me focus on one market. Let me become an expert. Let me understand what's really right for my portfolio, not for Ian or for Jason. Let me focus on what's right for me at this particular point in time. Let me get really good at it. Things start changing. But early on, I was like a chicken without a head. And how many of you are out there like that? I'm looking for deals. Well, if you don't know what the hell a deal is and how you're going to know what a deal looks like when it presents itself, that was me early on. I think that was a big difference. And when we found that first deal, like I said, it did take us 18 months because we're two Italians in East Tennessee in the early to mid 2000s. And, y'all ain't doing business down here. It's the reality. We weren't great with brokers, but we found Ricky G who liked us. And Ricky G took us under his wing and said, I'm going to find you guys a deal. And ironically enough, the deal was on LoopNet. And it's really weird because you're starting to see deals come back on LoopNet. But back then, it's very similar to now. GDP sucked. The economy sucked. You couldn't raise capital. Everyone was doing seller finance deals. There were deals everywhere, but no one was around. And I think that's what's going to happen in the next 18 to 24 months. That's what I'm predicting, at least. And back then, it was very similar. We found this deal. It was really distressed. We got some seller carryback after 18 months, and we closed on it. And it was a weekly renters. So if anyone knows out there has ever dealt with weekly renters, that is a nightmare in and of itself. But hey, 25 units, great way to learn. It was just for me, it was an amazing opportunity. But after that, 3 months later, Ricky G found us another deal that was on LoopNet, and we bought that deal as well. That's how we started.
Hey, have you ever bought any pre this? Did you own any single family residential properties?
I didn't. I only owned
your first deal.
Yeah, I only owned the triplex. And then what happened is I went and bought a mobile home park, which I lost. Then I owned the strip center for about 11 years, which I sold back in 2017 when I came to Florida. I bought a couple of duplexes up in Rochester. So one of my early mentors said, hey, cash flow. And you guys were talking about, hey, Baltimore's got these high rates, high caps. So everyone's saying high cap rates, great cash. Well, if they don't pay you, it doesn't matter if you got a 30 cap. It's a 0 cap, people. And I learned that. But my problem was I wasn't in boots on the ground in Rochester, New York. If I had built a team and I was boots on the ground, it may have been a little bit different, similar to what you're doing, Ian, but I was investing from afar. And these homes are old. It was not part of the buy right criteria. If you're buying them, they're older. Every time you have to re-tenant it, there goes your cash flow for the year. There's no appreciation. There's no job growth. Taxes are expensive, insurance. And I was figuring out learning how to invest from afar. And then when I met Jake, everyone says, well, it's lucky. Well, hey, I got into the mentorship. I learned. I got into investing from afar. I learned. So when Jake presented himself and says, I'm going to Knoxville, I had already understood how to property manage from afar, for how to look at assets from afar. And I just took that skill that I learned and I translated it into the opportunity with Jake.
Those high cash flow, high cap rate, no resale, no actual sales value properties. They just work on paper.
That's what that gets you, boys, right there.
Those things just work on paper. And I get presented those loans I get presented deals like that to do loans on them all the time. I'm like, this thing's not worth anything. And it's like, well, it's bringing in $2,000 a month. And I was like, maybe for the first month when you get your tenant in there, but that's it. And no harm intended though, because in all reality, like that is a place that a lot of newer real estate investors start, just because they're affordable. They see the rents in place. They're able to get that deal under contract. I'm not saying they should start there, but a lot of people kind of fall into that trap. And I think if you're an owner operator, an owner user, and like you really want to micromanage the hell out of that thing and you're local, sure, it could work. If you don't have a lot of your own funds to start with and things like that. Let's talking about funds to start with. You mentioned there was a seller financing component to this. Did they finance the whole project, or did you guys put up cash? Did you guys get a bank loan?
We did, but let me mention your point is so excellent, Jason. You can start there. You don't have to end there. I started in depressed properties. It's called trading up. You're starting with more what we call in this part of the market cycle, value add. We just call them distressed. So it's okay to start there. That 25 unit property got us to a 36 unit and then got us to 136 units, then got us into a better median income, better asset class, better vintage. Don't stop and hesitate for all these stars to align and say, I need this, shiny object, 4 cap in the middle of the city with $80,000 median income. No, just start with any property. And I always say, think big, start small. You don't have to start with an 80 or 100 units. Start with a quad, start with a house hacking, understand the business, but don't make the mistake that I made. I think when you're starting out, I want you all to look at real estate as a business. Every deal and every property you buy is its own little cash machine. It's its own little generating revenue. Where I love about multifamily is you can have multiple streams within there, whether it's laundry, whether it's cable, whether it's move-in deposits, whether it's late income. That's the I think the benefits to multifamily, because you can scale that way. But if you have the mindset of becoming an entrepreneur within real estate, that's where I think people should start. It doesn't matter how big the asset is. On that first deal, it was 80% bank financed. They held 10% as a seller carryback, and we bought 10% as a down payment. So for us, it was a $600,000 deal, 25 units. It was, so we had to come up with about $87,000 as a total down payment with closing costs and all. It was me, my brother, and Jake. So it was $27,000 each. I mean, it was awesome. And we're seeing that right now. We just had a student do a 102 unit apartment complex in South Carolina. They got an $18 million seller finance note. They got to raise $9 million, $18 million, 6%, 10 years IO. How freaking awesome is that? And people are saying you can't do it. And why would they do that? Well, they don't want to pay the capital gains. They're probably going to make more money from that note than they are cash flowing the property right now. So it's just a home run for them because they got no more managerial responsibilities. And if these guys don't pay, it's in an A sub-market in South Carolina that they'll just take the property back. And they got $9 million anyway. They got more than enough to go play around with. So it's out there right now. And I think it's just one of the strategies that you have to learn in this part of the market cycle.
Ian, share your story with Gino real quick.
Well,
you got it. Even though we're interviewing him, you got it because it's so relevant.
Hit me.
Yeah,
hit me.
It's, we did a 76 unit apartment building, and the seller offered us now in Baltimore that equates to about $5 million. And long story short, she said, I'm owner financing 90% of it. And we said, well, there's no way. And she's like, yep, I'm doing it. My business partner is literally like, this is fake. I'm not going. I said, I'm going to the meeting, dude. I don't know what to tell you. I'm going. And it's been the best deal ever. We wound up refinancing her, only brought 10% to the table, wound up refinancing her. Now she's one of our biggest capital investors that we have, because we established that relationship. And I think you're hitting the nail on the head. You're basically ruining. This might as well just be the prediction show. But with that being said, is like, I tell sellers right now is like, look, I can't control the cost of capital. You can help on price. And if you're willing to do this, you can help the cost of capital that allows us both to get to our common ground here. You want to sell, we want to buy. Just, I can't, this factor over here is a mess. And I won't make it political, but maybe after 2024, it'll be a different scenario. But as of today, the cost of capital is ridiculous and deals just aren't going to get done. You lower your price then. I don't know what you want your price. You need to control my cost of capital. And a lot of sellers, and I think you're hitting it, and I'm going to steal your show here, but it's you're in a B2B, right? That's why we do self-storage. That's why we like it. It's a B2B, and that owner on the other side of it understands it probably the same way the multifamily operators understand it in a similar fashion.
Ian, we had done a deal in 2015, and I remember this real clear. I was in the storage shed of my restaurant, and I'm doing $10 an hour work. And I got the phone jammed to my ear. I'm like, I got pizza boxes. I'm doing all this shit. And I got the phone to my ear, and I'm talking to Jake, and we're negotiating an $11 million deal. All seller finance, 80% bank, 20% seller. This is the deal of a lifetime for me. It's $11 million. And people are going to say, well, why would the guy do that? Why would they do that? Well, when you step back and you find out what their pain points are, he had tried to sell the business to his brother. He had to take it back. He had 5 sisters working in property management. They're all driving Beamers. The first month's rent was $140,000. We took over. It was $170,000. Now, we ain't that good. I'm going to be honest with you right now. So where did $30,000 go? A month go. So He seller financed it. The bank took 80. He came up with 20. We walked away from closing with $110,000. The title company's like, I've never seen this before. I'm like, you may never see it again, but it's possible because it's all you're doing is solving a problem. And that deal, we still own that deal. We refied it twice. Deal's probably got to be worth, no joke, it's 300 unit deal. It's probably got to be worth $30 million right now. We just kept refining it. It's in a great submarket, but those deals are out there. You just have to understand what you're looking for. You don't lead with seller financing. You say, here, he wanted 12.6 million. It was on LoopNet. And I said to him, I'm sorry, 12.6 is not going to work. I mean, I just can't get the financing. Debt coverage ratio is like 1:1. He goes, how about we do $11 million seller financing? I'm like, okay. He proposed it to us. Yeah. And then the reason was all he wanted to do was to buy a Porsche, drive cross country, get his $3 million in cash. And what was he going to do with the cash? He was going to put in the bank at 1%. Well, isn't a freaking $2.5 million note at 5% a lot better than $2.5 million in the bank at 1%? Don't always think from yourself. Seek first to understand, then to be understood. Understand what their motivation is. Their motivation may be a lot different than yours. He wants to ride off in the sunset across the country with the Porsche making 5%. He doesn't want to deal with his cousins and his aunts and his brothers and his sisters ripping him off anymore. He wants close. He wants to be able to make sure that deal is closed and he doesn't have to think about that ever again. Understand that's how seller financing works.
Yeah, that's a really good point because we solved the problem for our owner who wanted to take care of her mother, which was $20,000 a month in-care home or, in-home care. And we said, how do we manipulate this mortgage, whether it's term, it's rate, it's price of the property to get her $20,000 a month. And it makes financial sense for us. I mean, I'm just thinking, man, I wish I walked into your pizza shop back in the day. Probably had some really intense conversations over that counter, huh?
Well, it's really interesting. I'm glad you bring that up because my partner, Mike, who we still have as a partner, comes in one day and I got my pizza code out. I got pizza sauce on and everything. He sits down. He's a hedge fund trader. So he's working in New Canaan, Connecticut. He's a sharp dude. He's CEO of Louis Dreyfus right now. And he starts talking about China and gold and commodities. I just bantered back with him. And I said, Mike, we just bought a 25 unit that's grossing 13 grand a month. We paid 600 grand for it. You got a house in New Canaan. You paid $2 million. You're getting 10 grand a month. I mean, do the math. I'm making 3 grand a month more with 1/4 the amount of. So he stops for a second. He's like, this guy, pizza guy. He goes, how do you know all this? I said, I don't know. I said, it's just my turn to get out of this restaurant. I have a burning desire. So that very first deal, that's why I tell people, don't wait till the stars align. Take action. And then you never know when your Mike walks into the room and you have that conversation and you're prepared. Because from that very first deal, he wasn't our partner. But from that deal henceforth till today, he's been part of the team. And he, if it wasn't for Mike and it wasn't for Jake, I probably wouldn't be here. Because on the third deal, he had the balance sheet. It was a $4 million deal. He lent Jake and me 500 grand as part of the down payment. We paid him 5%. When we refied the money out, he got his loan. He got his money back. And we all got flush with cash. I think that's the problem, that people stop themselves of what if this, what if that? I don't have the money. I don't have the experience. Just start taking action. And then if you're serious and you learn the business, people will gravitate towards you. If you have an opportunity, people are looking for opportunities to invest. And that's what Mike was looking for. He didn't need to invest with us because he's already in hedge funds. He's already doing commodities, but he understood the power of putting something into an asset. And he all saw the demographics. 12 years ago, everyone's moving down south. He knew the replacement. We're buying assets at 30 to 40,000 a unit, where replacements were 110, 120 a door. So he's not a dumb guy. He understood that. So be able to provide, what value can you provide for somebody? And I was able to provide the value of partnering up with us. And he had the value of his balance sheet and his business skills as well.
Well, I mean, it's such a limiting belief that I think a lot of real estate investors also have, that they can't raise capital, or they have these good deals, but I don't know where the money's going to come from. And I mean, I'll tell you firsthand, when we went and raised capital 16 years ago, not that it was easy, but every well-off, quote unquote, rich person we knew said, yeah, I can get this % return. I could have this ownership interest in real estate. It seems like a no-brainer. Like, go find good deals. And I think that's kind of been a common misconception for a lot of people. But then I think as they stay in this space, they realize, hey, I'm doing good deals, and these capital investors are begging me to be a part of.
Mm-hmm. I agree. There's two things that we got to do in this business. I think everyone should understand that you're sourcing capital or you're sourcing deals. I mean, like in the last 18 months, there weren't a lot of multifamily deals. I think in 2022, we probably did 70 units. But in 2023, Jake and I have closed on 330 units. It's just me, Jake, and my partner, Mike. No capital raising. We let our employees invest with us. But what could we have done in 2022? If we were raising capital, it's all about the investors. It's all about building the brand. It's about the systems and the processes that you're managing, whether you're asset managing or property managing. So there's always something to do in the business. And I think that fallacy of raising capital, you have to look at it from a different perspective as far as I'm concerned. You're offering people opportunities. You have to make yourself known. You got to be transparent. You got to be willing to work hard. You have to have people trust you. I don't know if they have to like you, but they got to trust you with their money. And you have to be a fiduciary. And if crap hits the fan, they're getting their money back one way or the other. And if they feel that confidence and they trust you, then they will invest in your opportunity.
Yeah. And the better the opportunity, the more likely they're willing to jump on. And winners want to be with winners. And if you're out there explaining what's going on and being transparent, that's one of the reasons I do the podcast with Jason. Mostly, me and Jason talk on the phone every day, and we're like, well, let's just take this material to the podcast. But a lot of it is, hey, this is what's going on real time in our business. These are the people we're talking to. We're hanging out with Gino. We're hanging out with so-and-so guests. We're learning about their business. We're learning how they're investing in flex space or multifamily or self-storage or any asset class in between. So I think it's important that you wear your heart on your sleeve. What for someone that's, just talking to you here in these past few minutes, like, I'm like, damn, I wish, and look, we're very grateful for where we are today, but going from zero to multifamily, how many people can actually do that? Because when I sit here and talk to you, I'm all amped up to just go and be like, yo, damn it, I screwed up. I should have just went right into multifamily. What's the bet? Like, is there barriers there for people that they need to be aware of? Because I think also I had a maturity level issue that probably wasn't a good thing that would allow me to jump right in. But how many people you see successful jumping right into multifamily and skipping the single family space and being successful at multifamily?
Mark Twain has a quote, and I forget the quote how it exactly goes, but it says something to the effect of, it's not what you don't know that's going to get you in trouble. It's what you know for sure that just ain't so. And what I mean by that is most people don't even try multifamily because they have these beliefs about, I don't have enough money, or I don't have enough experience, or I don't have enough time. When in fact, that's holding everybody back because you can syndicate deals and raise money. And if, by the way, Ian's got a deal and I want to get in and Ian's a sponsor, I could possibly co-GP with Ian and bring a couple $100,000 to the deal. But no one, very few people even know that exists. And it's interesting when people join Jake and Gino, they're like, oh, wow, I can partner and get into a syndication with somebody else. Well, you're leveraging their skill set. You're leveraging their experience. They need capital because they've got 3 or 4 deals going on. They can't raise the capital for all their deals. So they need the Jasons and the Ians and the Ginos of the world. And then you get in that way. And then you get experience that way. And then possibly you can start doing your own syndications. Or if you'd like to get in with a duplex, a quad, what's stopping people from that? I think we stop ourselves from that. And I did the same thing. I went from that multifamily that I first started out to giving somebody my money because I didn't have confidence in myself. I didn't think I could do it. And I think that's what a lot of us do. For you, I think most people like single family because we've all bought houses. Or anyone listening to this show, the vast majority of us have bought a home and it's very comfortable. And it's like, oh, I can buy a home. Oh, I can buy another one. And before you know it, you've got 10 homes. You're running around the whole city. You can't manage them because they're all different, right? You got to have 10 different insurance bills, 10 different tax bills. It's like, crap. Why did I do what Jake and Gino did and just bought a 25 unit? It's one closing. All I have to do is 1 to 2 deals a year, a couple hundred units a year. That's all I got to do. And I am happy as a pig in crap. Whereas if I'm doing single families, I've got to buy 10, 15, 20, and it's just a pain in the ass to scale them because I'm basically buying boxes. That 25 unit property was basically 25 boxes. You know, the air conditioning units were all in the same location. The hot water heaters were all in the same location, same flooring, same fixtures. It's a lot easier to manage. And I think once people get over that limiting mindset of not being able to do that, they're like, wow, what took me so long? And I have so many people like you say, I should have just started. You should start wherever you feel comfortable, wherever you think, because I think our behaviors are belief driven. If we believe that we can't do it, then we're never going to do it. I'm here to tell you it's accessible to anybody who wants to learn the business. But if you're saying to yourself, I don't know if I can, then you're going to believe your own inner talk. What I would say to you is go out there and go listen to a lot of people who have podcasts, because Jake and I are not rocket scientists. We're the pizza guy and the drug rep. I'm just saying, like, it's the business is not rocket science. It really isn't. Once you figure out buy, manage, finance, and a few other things, it's really not that difficult. I'm being completely honest with you.
We tell everyone we're just two dumb firemen, man. I mean, that's literally all it is. But I agree. It's if you have a buy criteria and you learn the financing side of things, you can literally do anything you want. And I think you kind of hit this earlier in the podcast when we were talking about it. Is you're buying a business, right? Like, I think when people look at real estate, it's almost like a hobby. And Jason and I talk about this a lot. Like, a lot of people treat it like a hobby. So it's easy to buy single family houses because it's a hobby. You can't go to the bank with a BS balance sheet or, I don't know, man, I'm just going to figure it out. This is my property management system. It's like, no, you need to have everything in order to go and operate that. You are literally buying a cash flowing business day one that you get to maximize and operate and grow the revenue stream.
Mm-hmm. I agree 100%.
Yeah. Yeah. I mean, no, it makes sense. I mean, I think taking, the money side apart away from it, because I think it's not just the money side. I think people are like, well, how can I buy this $2 million property? There's a lot of risk. It's $2 million. Right. And they think dollars and cents, where I think we can all agree that $50,000 crap hole property you bought probably has significantly more risk. I mean, on a lender side, the bigger stuff is significantly safer for us to do than the smaller stuff. And there's no money to be made in the smaller stuff. So if any listeners right now can get over the hurdle of their limited beliefs, do bigger stuff, because you're going to make more money. It's going to be a heck of a lot easier, and you're probably going to have less risk.
Jason, let me add one thing to that. I would tell everybody out there, when I hear the excuse, it's I have no time and I have no money. I have 6 kids. I lived in New York. I didn't have a ton of savings. I didn't have a lot of time. I homeschooled the kids and I had a restaurant business while I started the real estate. So if I didn't use that excuse, we're all using that excuse. And the money, well, all of these entrepreneurs that started with nothing, whether it was Apple, whether it was Facebook, whether it was Dell, whether it was Microsoft, they didn't have a ton of money either. So the money doesn't stop them. Read the book, The Psychology of Money. Understand what your relationship to money is. That's the most important thing. The only relationship that I had was I was a really good saver. I could save money. And then for me, it was hard once I had it in the bank to be able to put it into a deal, because then it was gone. But then once I saw it come back to me in a refi, I'm like, my psychology has changed. I'm saving to buy assets, and these assets are paying for the events. I'm not saving for the event. I'm not saving to pay for college. I'm not saving to pay for retirement. I'm saving to buy an asset that's going to pay for that event. Everything changed for me, but my relationship with money is still such that sometimes I can't enjoy it for myself. I can spend the money on the kids and all, but for me, it's sometimes I need to get that money and I need to put it and buy an asset with it, or buy something where I'm going to derive some type of value from it. So go and read the book. Understand what your psychology of money is, because if you're always saying to yourself, it's too expensive, I can't afford it, I don't have enough. Well, when did you develop those ideas or the thought process with money? It was probably early on, and you heard it early on from people who are probably broke or probably had that mindset, and you just carried you through through your adulthood. And that's one of the reasons why I sort of had to cut myself off from my mom. I always heard we have to stay small, don't take risk. That's why I had one restaurant for 20 something years. How could I have 1,500 apartment units in less than 5 years with the drug rep, but have one restaurant for 20 something years? That makes no sense on its face value. And I had a good restaurant. We had really good food. I really knew what I was doing in that business, but I couldn't scale it. Why was that? It's all about the relationship that I had with money and the psychology that I had around business and my limiting beliefs and my thoughts.
I'm glad you brought that book up, because that's one of Ian and my favorite books. And we've read it multiple times or listened to it on Audible multiple times. And every time we do, we're like, hey, here's a few other things we should dive into this. It's good. So obviously it's great, actually. So obviously you have an impressive resume in your own portfolio related to, I know you do some coaching and some education, and you have, I'm guessing, a good amount of students that you work with. So they've got 55,000 units so far that are done. Is that correct?
It's up to 75,000 now.
So how did that get started? Like, and what was your, I guess, original goal to kind of take it to that level and, help aspiring multifamily investors?
Jason, like everything else in life, it started slowly. I mean, it's one of those things. We wrote a book and I was actually doing some coaching on it. Why did I start Jake and Gino? Like really subconsciously, what made me want to start it? Because I didn't need to. I just left New York, went to Florida. Jake's doing the portfolio up north. And I'm like pretty bored down here. Like everyone thinks retirement, go to the beach. That crap gets boring. After 3 days, I'm like, what the hell am I going to do? And I said, let's just write a book. We wrote the book, Wheelbarrow Profits. And I was doing work with a coach. And the coach really pulled the story out of me and basically said, it seems like you started Jake and Gino because you wanted to carry on the legacy of your dad. Because my dad was a great role model to me. He was a great mentor. I love the way that he worked. I love the way that people respected him. I love the way how he created impact through his food. Everyone loved his food. His employees really liked him. And I think that's what I wanted. And I just used real estate and multifamily and Jake and Gino as the conduit for myself. So it's sort of selfish because I'm starting it out with the guise of monetizing. But that's not why you do it. I'm not here on the day after Christmas to monetize. I'm here on the day to kick it with two real estate guys to possibly learn something and to make my community better and to have fun and to speak to people that I could never speak to unless I'd have to pay thousands of dollars for. So I started out just as a fun project. And 7 years later, it takes a couple of years for it to build up. You need to get students who start the training, who go through the buy right, the manage right, the finance right, who make some mistakes, who buy some deals and then refinance. And then 7 years later, you're like, holy crap. We've impacted, hundreds of people. There's over 120 people who have left their jobs through Jake and Gino and started doing the real estate full time. And for me, I love it. It's hard to explain to you. Like, you think you're just doing some podcasts, you're writing some blogs, you're writing some articles, but I've got people saying Merry Christmas to me that 5 years ago, I had no idea who they were. And it's amazing how you've impacted their lives, but they've impacted my life almost as much as I've impacted theirs because our students are really smart people. And there's so much to learn from them and being able to do different retreats and not just focusing on multifamily, but the personal development aspect of it. It's so important to multifamily. Anybody can do multifamily. Anybody can do the mechanical part of it. It's 80% psychological. It's 20% mechanical. If you can work on the psychology part of it, and that's what I'm trying to do with Jake and Gino, is work on the psychology part by doing all these content pieces and by being on podcasts and by sharing my story and saying, hey, it's not easy, but if you stick with it and you work on it, anybody can do it.
Yeah. And it's almost the same as people say to us today, like, hey man, and they probably say the same to you. You have enough. Yeah, no shit, I have enough. But you know what? It's selfish for me to stop.
Yes.
We have a team. We have other people who want to produce. They want to grow, right? Like our team every day, they're like, well, we want to do more, because people, if they're not growing, they're dying. And I think you hit the nail on the head when you said, yeah, retirement, I'll just go sit on the beach every day. And it's like, yeah, like everybody, the fantasy of that is what they want. But I can tell you right now, like, it's not real. Like if you're a real producer and you're really impacting lives, you can never shut it off. There's a meme going around now where it's like W-2 employees asleep, entrepreneur that's asleep, and the entrepreneur is just wide awake with 1,000 things on their head, and the W-2 employees asleep because we are producers. We are creating impact. I think that's a really powerful statement that you say right there, because a lot of people take, oh, he's coaching for, but no, you're coaching because you truly are impacting other people. Buying more facilities is impacting people, not only from how they live, but the employees, the vendors, everybody who survives off that financial chain that comes from doing that deal, I think is really, really important.
And Ian, you said it too. We're talking about the psychology of money. It's autonomy. In the book, they ask, when is too much, too much? We're not chasing money. As an entrepreneur, when you're financially free, you're chasing opportunity. Money just shows up. Money's the result, right? That's what goals are the result. We like the system and the process that leads to that. That's the difference between people who are financially successful and those who aren't. Those who aren't, like I used to be, I'd work every day. On Sundays, I'd get paid. I'd rinse and repeat. That's what my process was. I was never financially free. I never had the autonomy that they talk about in the psychology of money. Once you get that autonomy, to me, it really does lead to happiness because I don't have to really worry about coming in to do a podcast to pay the bills. I'm here because I want to be here. We're all trying to achieve our sole purpose, why we're on this planet. And if you have the bills paid for and you can do something you really like coach or like help others or like do podcasts or do masterminds, whatever it is that lights you up, that's why you're here. Money is just a result. Multifamily is just a vehicle to get you there. That's what people don't understand until they're there. Like, oh, wow, I've been working all these years for money. No, you've been working to chase opportunity. That opportunity will bring the money.
Yeah. And the reality of working with students or clients that you're charging money for to begin with is if you did this for free and you didn't charge them any money, you'd have a 0% success rate.
Zero.
Because they wouldn't take it seriously.
Yes.
The more they pay, or the more you pay, the more you pay attention. I mean, think about anything in life, right? Like, you know, when you get into real estate, hey, you read a book, right? You read a book and it's whatever, $10, $20. And that's the amount of value that you potentially get, right? And then psychologically, hey, I'm going to go buy $1,000 course or a boot camp or a mentorship program or a mastermind or whatever the case is. And you're continuing to kind of grow, you know, first with your head as you continue to buy and pay more attention to that thing. We see it all the time inside our mastermind group. You know, we've done some private consulting as well. And the folks that we have done consulting with, I mean, they're peers, right? They're equals. A lot of them probably are more successful than we are, right? Like in different ways. I'm an expert in private lending. You're an expert in multifamily. Ian's an expert in potentially self-storage. But at the same time, like the people we're working on want to become experts in that. And they understand the value of, hey, if I pay for this, I know that if I pay $10,000 for this, that number one, it's going to psychologically get me involved immediately, and I'm going to shortcut 1 year, 2 years, 5 years by just having them help me to do so. So I think that's also a very common misconception for a lot of folks that, you know, want to get into into some sort of mentorship program to begin with. Like they haven't they're not ready if they haven't pulled the trigger and pulled out their wallet.
It's accountability. When I'm paying for something, I'm going to show up. I'm going to be prepared. If I've got a call with my coach, and I've gone through this, I've done hundreds of thousands of dollars of training. I'm doing a speaker training right now. Every Sunday from 10 to 11:30, we need to show up. And I paid for it. You know, I can't come this Sunday. Well, I'm showing up because I paid for the damn program. And if you remember Maserati Mike, did Maserati Mike have any money in the deal? He had zero money in the deal. He had no skin in the game. So it's similar to your education and mentorship. If you have nothing invested in it, you can just walk away. Mike just walked away from that deal. He had nothing to lose. I had all the skin in the game. I had all the money in the game. And that's how it translates to personal development. If you're not paying, if you're not putting in something into it, you're not going to show up. It's either you learn on the street or you learn in the classroom. I've done both. And learning on the street is really expensive, really painful. And do you really learn? You learn, but you don't learn as well as you do if you're finding people who are really successful and have done it and follow their process.
Yep. Yeah, there's hard-headed idiots like me that will be like, Gino's lying there. No way, no way, no way. Bang in the head. All right, Gino. All right, I'll listen to you. You know what I mean? It happens, you know, but
yes,
some people need to learn in every different way. Gino, one thing we like, well, first off, this has been an insanely great conversation. Guys, 2024, like if you're looking to kick it off, you know, whether you do something with Gino or you're doing something on your own or you're doing something with one of us, whatever it is, go do it. Just go swing the bat. Maybe it is. I've always wanted to learn from someone. Go swing the bat. Go do something. And I think this will be a great episode for everyone, and hopefully they get all the bombs that everyone's dropping here on this one. But one thing we like to ask all of our guests is, what's one book or podcast that you think everyone should read or listen to, or something that's relevant right now?
Wow. We mentioned The Psychology of Money. And for me, it's one of those books that even the limiting beliefs, even should I pay for my education? It's just a word. Is it an expense or is it an investment? It's really what your relationship with money is. Are you getting more value by paying Ian for his mastermind than what your money's worth? I'd venture to say 99 times out of 100 you would be. One of my favorite authors, honestly, is Stephen Covey's this 7 Habits. And I read it back in 2008 and it didn't really resonate with me. But when I read it again a couple of years ago, all those habits, if you really chunk them down and distill them down, if you're doing all 7 of those habits, there's no way that you cannot become successful. There's just no way. I mean, he's really drilled it down in the book, and it's a phenomenal book. It's not a hard read. It's pretty simple, like investing in multifamily. But if you can take those, sharpen the saws, first things first, start with the end in mind. I mean, like, seek first to understand, then to be understood. All of his habits in that book are really profound. And if you can follow those habits, whatever your business you're in, whether you're doing lending, whether you're in self-storage, whether you're multifamily, at the end of the day, it's just business. That's all it is. And there's so much we can learn from each other that crosses over the different real estate niches.
Yeah, isn't it funny how we talk about it all the time? Like, and a lot of the guests say the same things. Like, yeah, I read this book one time, but then I came back and read it again. I was like, holy shit, like
yes.
you can't see it right here, but I got Atlas Shrugged up on my thing, and we read it in high school, and it didn't resonate with me. And then Jason and I did it in whenever Trump was getting ousted last time. It was just so funny the last election cycle. It was so funny to listen about producers and people that are drag on society and all the stuff that was going on in the political arena. And you're like, oh my God, they're doing it to this guy. It was like, holy crap. But it's amazing how certain books resonate with you at certain points in your life. So
I can't read that book. I started reading it. I'm like, I don't got to read it. I'm living it. Why would I read a book that I'm living every day? My partner loves the book. He's enamored with the book. A lot of our LLCs are named after characters in the book. So it's really interesting. He loves that book.
It resonated. I think we just really needed something to mentally just like block everything else out and like live it. And it was fun. Sometimes it's fun just to read a was that nonfiction or fiction? I don't know. I'm so bad with that crap, but not a real book, like a made up one. But think about that.
But it wasn't real.
It was real, but it wasn't real. But you know what I mean? Like, she wrote that in the 40s, right? Or the 50s or something. Like, the fact that book and those traits about everything she wrote about, the principles that are still around today, and you can identify them. The same thing you're talking about, the 7 Habits or the Psychology of Money or any other book, the fact that you can apply those principles, and one day, hopefully someone reads all of our books and they're like, man, those principles still apply today, 50, 70, 80 years from now. That means you've really mastered life or skill or whatever it is, and you truly are helping other people.
Mm-hmm.
I keep wanting to say Jake. Gino. We got to change it to Gino and Jake, and then I always say Gino first. But Gino, what's the best place people can find you if they really do want to do something in 2024? How can they track you down on the internet, learn more about what you guys do?
Ian, we can't change it to Gino and Jake. It doesn't sound as good. My kids keep asking me that. I said Jake and Gino rolls off the tongue, and me and my wife have a podcast called The Julia and Gino Show. It can't be Gino and Julia. Julia and Gino sounds better than Jake and Gino. Just go to jakeandgino.com. And listen, I got a book here. It's called Creative Cash. One of our coaches wrote it. If you want a PDF copy, just email me, gino@jakeandgino.com. I'll send you a PDF copy. This book is got seller financing, seller carryback, master lease options. We've got a negotiation technique in here. We've got the 3 pillars of real estate. Bill wrote this 2 years ago, knowing that seller financing was coming. It's just COVID prolonged things. It just extended the cycle up. But this book for the next, I would say 2 years, there's going to be a lot of opportunity in the seller financing space.
No doubt. I certainly agree. Gino, any last words? We certainly appreciate you spending near the last hour here with us.
When I think about real estate, what it's done for me and for my family, I think it's just an amazing way to create wealth. It's an amazing way to take control of your destiny. And it doesn't have to happen overnight. Give yourself some time. We go to college for 4 years to get out, to get a job, and then go back for another 2 years. So if you spend the next 12 to 18 months learning the business, not doing a deal, that's okay. For Jake and I, first 18 months had goose eggs. Then after 24 months, we had 200 units. And after 4 years, which is a 4-year college degree, we had almost 500 units. So just take your time. Don't beat yourself up. Pick a niche, learn the niche, and shut off the noise and focus on what's right for you.
Certainly appreciate it. Final last words. Thanks again, Gino.
Thanks, guys.
Thanks for tuning in to the Real Estate Reserve podcast. Do us a favor and like, comment, and share our broadcast. It helps the algorithm and helps us spread the word too. Till next time, thank you for tuning in.